Most traders believe their biggest obstacle is knowledge. They assume that somewhere out there is a missing piece, a sharper entry, a cleaner pattern, a more refined confirmation. They believe that once they fully understand the market, discipline will follow naturally. Confidence will feel automatic. Execution will become easy. But that is not where the breakdown begins. The real instability does not start in your strategy. It starts in your nervous system the moment risk becomes real. There is a subtle shift that happens when you enter a trade. Before entry, you feel analytical, calm, detached. You are evaluating probabilities. But the moment your order fills, something changes. Now there is exposure. Now there is vulnerability. The numbers on the screen are no longer abstract. They represent gain or loss. They represent validation or failure. Your body reacts before your mind does. Your breathing becomes slightly shallow. Your chest tightens. Your attention narrows. You begin to monitor every tick, not because you lack discipline, but because your nervous system has registered uncertainty as potential threat. Most traders interpret this reaction as weakness. They tell themselves they need more willpower, they need to be tougher, they need to force themselves to follow rules. But discipline is not a force problem. It is a regulation problem. When uncertainty feels threatening, the body shifts into survival mode. In survival mode, the objective is not long-term consistency. The objective is immediate relief. Relief from discomfort, relief from doubt, relief from the feeling of being exposed. This is where rules begin to bend. You move your stop not because you are irrational, but because your system is trying to avoid the emotional pain of being wrong. You take profits early not because you lack knowledge, but because locking in gain reduces anxiety. You add to losers not because you do not understand risk, but because hope temporarily numbs the stress response. These behaviors are not intellectual failures. They are biological reactions to unmanaged risk. Most trading education stops at structure. It tells you to define entries, fix risk per trade, set daily limits. These are useful, but structure alone does not create stability. Because if your internal capacity cannot tolerate the size you are trading, no rule will hold under pressure. The real question is not whether you know what to do. The real question is whether your nervous system can remain regulated while doing it. Discipline is often framed as moral strength, as if consistent execution is a character test. But in trading, discipline is the ability to stay internally stable while outcomes fluctuate. You are not fighting the market. You are managing your own exposure threshold. Every trader has a size at which clarity begins to distort. Below that size, decisions feel clean, objective, mechanical. Above that size, perception shifts. You begin to overinterpret information. You search for confirmation. You imagine scenarios. You feel urgency. The strategy did not change. The exposure did. Small position size does more than reduce financial risk. It reduces psychological intensity. When intensity decreases, the nervous system remains regulated. When regulated, you can execute without internal conflict. Consistency is not built through force. It is built through tolerable exposure. Many traders believe discipline means executing even when every emotion is screaming. But if every emotion is screaming, your system is already overloaded. Long-term professionalism is not about suppressing that overload. It is about sizing yourself so that overload rarely occurs. Stability before scale. The amateur trader focuses on outcome. Did this trade win or lose? The professional focuses on state. Was I regulated while executing? Because over a series of trades, state determines consistency. You cannot think probabilistically if your body is in survival mode. Probabilistic thinking requires emotional neutrality. It requires accepting that any individual trade can lose without interpreting that loss as personal failure. The moment a loss feels like identity threat, discipline fractures. This is why many intelligent people struggle in trading. In most professions, effort correlates with outcome. Study more, perform better, work harder, advance further. Trading does not reward effort in the same linear way. You can execute perfectly and still lose on a given trade. If you are not internally prepared for that reality, you will try to control what cannot be controlled. Control appears as overanalysis, as hesitation, as interference with exits, as emotional size adjustment. Underneath all of it is discomfort with uncertainty. Uncertainty is not just an idea, it is a sensation. It is the feeling of not knowing what will happen next while money is exposed. If that sensation feels threatening, your behavior will shift automatically. Real discipline begins when uncertainty no longer feels like danger. This does not mean you eliminate emotion. It means you increase capacity. You build tolerance to small losses. You experience them repeatedly at manageable size until your system stops interpreting them as threat. Loss becomes information, not identity. Over time, something subtle changes. You stop reacting to individual outcomes. You start thinking in sequences. One trade no longer defines you. It becomes one data point in a larger distribution. When you truly internalize that edge exists over a series of trades, attachment to any single trade weakens. But this belief must be embodied, not repeated as a concept. Embodiment happens through repetition at stable exposure. You risk small enough that a loss does not destabilize you. You follow your exit without negotiation. You observe the discomfort without acting on it. And you repeat. Gradually, your nervous system learns that nothing catastrophic happens when a stop is hit. The perceived threat decreases. Regulation improves. This is how discipline becomes natural, not forced. Many traders attempt to jump directly to high size while still emotionally reactive. Say, they believe larger size will accelerate growth. Instead, it amplifies instability. The intensity overwhelms their regulation capacity and their rules dissolve under pressure. Professional trading is quieter than most imagine. It is not fueled by adrenaline. It is not dramatic. It is methodical, measured, repetitive. The professional protects state first, capital second, because they understand that damaged state leads to damaged decisions, and damaged decisions lead to capital loss. Bad days are inevitable. There will be sessions where nothing aligns, where setups fail, where losses cluster. On those days, the unregulated trader increases intensity, trades more, risks more, attempts to recover emotionally. The regulated trader reduces intensity, stops earlier, or decreases size, not out of fear, but out of respect for state. Stopping is not weakness. It is containment. Revenge trading is not about anger. It is about dysregulation. The body seeks resolution. It wants to close the discomfort loop created by loss. Taking another trade promises relief, but relief is temporary if the state remains unstable. Increasing size emotionally is also a regulation error. After wins, arousal increases. Confidence shifts toward overexposure. After losses, desperation increases. In both cases, size becomes a tool to manage internal state rather than a fixed component of process. When size fluctuates based on emotion, discipline cannot exist. Fixed risk works not because it is mathematically superior, but because it removes emotional negotiation. It standardizes exposure so the nervous system can adapt predictably. Structure supports regulation, but regulation must still be cultivated. Journaling becomes powerful when it focuses on state rather than just statistics. After each session, the critical question is not how much was made or lost. It is how stable you remained. When did tension rise? When did you feel urgency? When did you want to interfere? These moments reveal your exposure threshold. Self-honesty is not about self-criticism. It is about accurate measurement of capacity. Over time, patterns appear. Perhaps you become reactive after 2 losses. Perhaps after 2 wins, you feel invincible. These patterns are not character flaws. They are predictable nervous system responses to intensity shifts. Once visible, they can be managed. For example, if you know that 2 consecutive losses elevate tension, you can reduce size on the next trade or step away briefly. Not because the strategy changed, because your state did. The shift from emotional trader to regulated professional is not dramatic. It is gradual. It happens when you stop asking, how can I make more, and start asking, how can I remain stable? Money becomes a byproduct of stability. This is where many traders misinterpret discipline. They believe it is about pushing through discomfort. In reality, it is about resizing discomfort so it becomes tolerable. Small size builds clarity. Clarity builds consistency. Consistency builds confidence. Confidence built on regulation is quiet. It does not need to prove itself through oversized risk. As your capacity expands, size can increase naturally. But scale must follow stability, not precede it. The market does not test your intelligence. It tests your ability to remain neutral in the face of uncertainty. If you attach self-worth to outcomes, every fluctuation becomes emotional. If you detach identity from individual trades, fluctuations remain informational. This detachment is not indifference. It is professionalism. There may come a point where you recognize that trading continually destabilizes you despite repeated effort to regulate. In that case, stepping away is not failure. It is accurate self-assessment. Not every environment aligns with every nervous system. But if you are willing to develop capacity gradually, trading becomes less about prediction and more about self-regulation under uncertainty. Over time, discipline stops feeling restrictive. It feels relieving, because you are no longer battling yourself inside every trade. You are simply executing within your capacity. Freedom in trading does not come from doing whatever you want. It comes from not being controlled by internal reactions. When you can accept a loss without tension. When you can take a valid setup after 3 losses without hesitation. When you can end the day after reaching your limit without bargaining for one more trade. That is discipline. And that discipline is not loud. It is stable. Most traders underestimate how quickly intensity compounds. 1 loss is manageable. 2 losses in a row begin to create narrative. 3 losses and the mind starts forming conclusions. Maybe the strategy is not working. Maybe the market has changed. Maybe you are out of sync. The internal dialogue accelerates long before any statistical edge has meaningfully shifted. This is the moment where discipline is tested, not at the level of rule knowledge, but at the level of internal tolerance. A professional understands that edge expresses itself over distribution, not isolated events. Even with a 70% win rate, losses are built into the structure of the system. There is no version of trading where losing disappears. When you truly think in probabilities, you internalize something simple but powerful. Independent outcomes do not care about your recent history. The previous trade has no emotional memory. The market does not compensate you for discipline nor punish you for frustration. Each trade stands alone within a larger statistical field. But your nervous system does not interpret independence naturally. It searches for patterns. It wants meaning. After consecutive losses, it interprets danger. After consecutive wins, it interprets safety. Both interpretations distort perception. This is why consistency requires more than intellectual understanding. It requires emotional neutrality in the face of short-term streaks. When you skip a valid setup because the last 2 trades lost, you are not lacking knowledge. You are reacting to accumulated emotional load. The body wants to avoid another hit. Avoiding pain feels protective. Yet skipping valid trades erodes the integrity of the distribution. Likewise, when you increase size after a winning streak, you are responding to elevated arousal. Confidence feels expansive. Risk feels smaller. But exposure has increased, and if the next trade loses, the emotional swing becomes sharper. The solution is not suppression, it is containment. Containment means defining exposure before emotion enters the equation. It means deciding risk parameters when you are calm, not when you are stimulated by outcome. This is where fixed position sizing becomes psychologically stabilizing. Not because it guarantees profit, but because it reduces variability of emotional intensity. When size remains constant, your system learns what to expect. Predictability lowers stress response. Over time, this predictability builds resilience. The same applies to daily loss limits. Many traders resist stopping because they believe one more trade could reverse the day. But the urge to continue rarely comes from clear assessment. It comes from agitation. Stopping at a predefined threshold is not about quitting. It is about protecting regulation. Once emotional activation crosses a certain point, decision quality deteriorates rapidly. The professional recognizes this threshold early. The amateur ignores it until damage is done. There is a subtle but important distinction between being outcome-focused and process-centered. Outcome focus constantly evaluates whether the last trade was good or bad. Process focus evaluates whether execution aligned with predefined criteria. When you evaluate yourself based on outcome, your emotional state fluctuates with every result. When you evaluate based on process, your state remains steadier because the metric is within your control. Control in trading exists only at the level of execution. Everything else is variance. Many traders intellectually agree with this, but agreement is not embodiment. Embodiment shows itself in small moments. When your stop is about to be hit and you feel the impulse to widen it. Embodiment means allowing the stop to execute without internal negotiation. When price moves quickly in your favor and you want to secure profit early. Embodiment means holding to the predefined target if conditions remain valid. These moments are quiet. They happen in seconds. No one sees them. Yet they determine long-term consistency. If you observe carefully, you will notice that most rule violations occur when intensity is slightly elevated, not when it is extreme. A small increase in heart rate, a slight tightening in the chest, a subtle sense of urgency. These micro shifts precede action. The more aware you become of these signals, the earlier you can intervene. Sometimes intervention means stepping away briefly. Sometimes it means reducing size. Sometimes it means simply noticing the sensation without acting on it. Awareness is regulation. Another area where discipline often collapses is boredom. Boredom creates its own form of intensity. When markets are slow, the mind searches for stimulation. Taking marginal setups temporarily relieves monotony, but overtrading introduces unnecessary exposure. Professional patience is not passive. It is active restraint. Waiting for valid conditions requires comfort with inactivity. Inactivity can feel uncomfortable if you equate productivity with constant action. Yet in trading, inactivity is often a sign of alignment. You are not paid for activity. You are paid for quality exposure over time. There is also the dimension of identity. Many traders unconsciously link self-worth to performance. A losing day feels like personal failure. A winning day feels like validation. This linkage magnifies emotional volatility. When identity is fused with outcome, every fluctuation becomes psychological threat or reward. Discipline becomes fragile because the stakes feel existential. Separating identity from outcome is foundational. You are not your last trade. You are not your win rate this week. You are the executor of a process within a probabilistic environment. The more this separation strengthens, the calmer execution becomes. Sometimes traders attempt to accelerate growth by increasing size before internal stability is established. They tell themselves that pressure will force discipline. In reality, pressure magnifies existing instability. If you struggle to follow rules at small size, and increasing size will not create discipline, it will amplify reactivity. Growth in trading is nonlinear. It does not progress smoothly upward. It oscillates. Periods of clarity alternate with periods of confusion. The key is not eliminating oscillation, but narrowing its amplitude. Smaller emotional swings mean more consistent behavior. Over time, you may notice that losses no longer trigger the same internal response. Stops hit and you simply record the outcome. No tightening, no narrative, just data. This is not indifference. It is adaptation. Adaptation occurs because your nervous system has learned that loss at this scale is tolerable. It no longer signals danger. From this place, thinking in sequences becomes natural. You begin to view 10 or 20 trades as a single unit of evaluation. Individual results lose their emotional charge. Professionals often speak quietly about their edge because they understand it is fragile if interfered with. They do not chase every opportunity. They do not need to prove competence through frequency. Their confidence is anchored in repetition, not excitement. There is also wisdom in recognizing when trading may not align with your temperament. Some individuals thrive in environments with high variability. Others prefer stable, predictable systems. Neither is superior. But self-awareness matters. If repeated attempts at regulation fail despite sincere effort, reassessment is rational. Continuing in a chronically dysregulated state is costly both financially and psychologically. However, for those willing to build capacity gradually, trading becomes a laboratory for emotional maturity. It exposes impatience, greed, fear, and the need for control. But exposure alone does not guarantee growth. Structured reflection does. End of each week. Reviewing not just results but state patterns creates feedback loops. When did you feel most stable? When did you feel most reactive? What preceded those states? Over months, these observations refine self-understanding. With refined understanding, adjustments become precise. Perhaps you trade best only during certain hours. Perhaps you perform better after physical exercise. Perhaps sleep quality strongly influences impulse control. These are not trivial variables. They are components of regulation. Professionalism integrates life structure with trading structure. It does not isolate the two. Eventually, a discipline stops feeling like constraint and starts feeling like alignment. You no longer crave impulsive trades because they disrupt your internal equilibrium. Stability itself becomes rewarding. When stability becomes the reward, consistency follows naturally. There is another misconception that quietly sabotages progress. Many traders believe that if they just try harder, discipline will eventually lock into place. They approach trading the way they approached school or career advancement. Effort equals reward. Push more, focus more, grind longer. But trading does not reward strain. It rewards alignment. When you force yourself to act against a dysregulated internal state, you may achieve temporary compliance, but the tension accumulates. Eventually it releases through impulsive behavior. A sudden, oversized trade, a moved stop, a deviation from plan that feels justified in the moment. Willpower is finite. Regulation is sustainable. Real discipline is not gritting your teeth while your body is in fight or flight. Real discipline is reducing the intensity, so fight or flight does not activate in the first place. This is where gradual exposure becomes essential. You do not build emotional capacity by repeatedly overwhelming yourself. You build it by operating slightly below your stress threshold and expanding from there. If risking 1% of your account creates internal tension, reduce it. There is no rule that says growth must be fast. In fact, fast psychological expansion often leads to regression. The quiet trader who trades small but consistent for months builds deeper stability than the trader who swings aggressively between large wins and large losses. Consistency is boring from the outside. Internally, it feels calm. Another subtle destabilizer is comparison. Watching others post profits, seeing aggressive returns, hearing stories of rapid account growth. Comparison triggers urgency. Urgency pushes size. Pushed size increases emotional intensity. And intensity destabilizes execution. Professional growth is individual. It respects personal thresholds. It ignores external timelines. You are not competing against other traders. You are calibrating your own capacity. The market offers infinite opportunity. There is no need to extract everything now. This mindset shift reduces pressure. Reduced pressure improves clarity. Clarity improves decision quality. When clarity is present, you notice that many impulses are simply attempts to escape discomfort. Closing a trade early often relieves anxiety. Adding to a losing trade often relieves the discomfort of accepting error. Taking an extra trade after your limit often relieves the frustration of stopping. Relief-driven decisions are rarely aligned with long-term consistency. Instead of asking, will this trade make money? A more stabilizing question is, does this trade align with my predefined criteria and current state. State matters. There are days when your sleep was poor, when external stress is elevated, when focus feels scattered. On these days, capacity is lower. Professionalism may mean reducing size or not trading at all. This is not avoidance, it is calibration. Amateur thinking interprets reduced activity as missed opportunity. Professional thinking interprets reduced activity as capital preservation. Capital is not only financial, it is psychological. If you protect psychological capital, financial capital tends to follow. Over time, discipline reshapes identity. You begin to see yourself not as someone chasing outcomes, but as someone maintaining standards. Standards for entry, standards for exit, standards for exposure, standards for stopping. Standards remove negotiation. Negotiation is where emotional influence enters. When a rule is flexible, emotion finds space. When a rule is clear and consistently honored, mock emotion gradually quiets. Yet rules alone are not enough. They must be paired with acceptance. Acceptance of uncertainty. Acceptance of loss. Acceptance of imperfection. Acceptance that some days will not yield opportunity. Without acceptance, rules feel restrictive. With acceptance, rules feel protective. There is also the matter of time horizon. Many traders evaluate themselves daily. A losing day feels catastrophic. A flat week feels like stagnation. But statistical edges often require dozens or hundreds of trades to express clearly. When evaluation window is too short, emotional volatility increases. Expanding the evaluation window reduces sensitivity to noise. Imagine assessing performance over 50 trades instead of 5. The emotional significance of one loss diminishes. Perspective stabilizes. Professional patience extends beyond waiting for setups. It includes waiting for data to accumulate before drawing conclusions. Hasty conclusions often lead to unnecessary strategy changes. Switching systems prematurely resets the learning curve. It reintroduces uncertainty at a cognitive level, adding more instability. Stability thrives on repetition. Repetition builds familiarity. Familiarity reduces perceived threat. Reduced threat enhances regulation. Eventually, a shift occurs. You begin to trust your process not because it always wins, but because you have seen it operate over time. Trust reduces interference. Interference is expensive. Every time you override a rule, you introduce randomness. Randomness disrupts statistical edge. When randomness increases, confidence decreases. When confidence decreases, emotional intensity rises. It becomes a cycle. Breaking that cycle requires humility. The humility to admit that you cannot outsmart variance. The humility to follow simple rules even when you believe you see something extra. Ego often disguises itself as intuition. Sometimes intuition is valid, but without data it is indistinguishable from impulse. Professional intuition is built on thousands of repetitions, not momentary conviction. There will always be temptation to scale faster, to trade more, to extract more. But sustainable growth is incremental. When you review your progress months later, the changes may seem subtle. Fewer impulsive trades. Faster acceptance of loss. More consistent stop placement. More frequent adherence to daily limits. These subtle shifts compound. Compounding in psychology mirrors compounding in capital. Small improvements repeated consistently lead to large transformation. The calm trader at the end of the year may not look dramatically different externally, but internally, reactivity has softened. Urgency has decreased. Clarity has strengthened. This is what it means to move from reactive to stable, from outcome-focused to process-centered, from emotional intensity to measured execution. At that point, discipline no longer feels like effort. It feels like identity. You do not force yourself to follow rules. You simply do, because that is who you have become. And when occasional lapses occur, as they will, they are addressed calmly. No self-punishment, no dramatic narrative, just correction. Trading then becomes less about proving yourself and more about practicing consistency under uncertainty. The market continues to fluctuate. Wins and losses continue to alternate. But internally, the swings are smaller. This reduction in internal volatility is the true marker of development. At the highest level, trading is not a battle against the market. It is an ongoing negotiation with uncertainty. Every position you open is a voluntary step into the unknown. You place capital at risk without guarantees. You accept that the next outcome is not fully controllable. If that reality feels threatening, discipline will always feel like struggle. Many traders attempt to eliminate uncertainty through analysis. They search for more confirmation, more filters, more alignment across time frames. Analysis has value, but it cannot remove randomness. At some point, you must act without certainty. This is where identity becomes decisive. If your identity depends on being right, uncertainty feels like danger. If your identity is anchored in executing process, uncertainty becomes manageable. The shift is subtle but powerful. Being right is outcome-based. Executing process is behavior-based. Outcomes fluctuate, behavior can stabilize. When you consistently choose behavior over outcome, you gradually desensitize yourself to short-term variance. Losses still occur. Wins still occur. But they do not redefine you. Over time, you realize that discipline is not about controlling emotion. It is about not being controlled by it. Emotions will continue to arise. Fear before entry, relief after exit, frustration after loss, excitement during momentum. The professional difference is not absence of emotion, but absence of impulsive reaction. Between emotion and action, there is a pause. In that pause lives discipline. That pause is created through repeated practice at tolerable size. It is reinforced through structure. It is strengthened through honest reflection. Reflection is not self-criticism. It is observation without distortion. You review the session and ask simple questions. Did I follow my predefined criteria? Did I maintain size consistency? Did I stop when I said I would stop? If not, what internal state preceded the deviation? Over months of this practice, patterns dissolve, not because you forced them away, but because awareness reduced their power. Eventually, something shifts in how you perceive losses. They no longer feel like attacks. They feel like expenses, necessary costs of participating in a probabilistic environment. Every business has costs. Trading is no different. When you internalize this, resistance softens. Resistance is exhausting. Acceptance is conserving. Conservation of psychological energy improves longevity. Longevity is essential because edge requires time to express. Many traders fail not because they lack intelligence or opportunity, but because they cannot sustain stable execution long enough for probabilities to play out. Longevity requires pacing. Pacing means knowing when to step back. It means ending the day when limits are reached. It means taking breaks after emotionally heavy sessions. It means protecting sleep and physical health because regulation depends on them. Professional trading integrates self-care with execution. The two are inseparable. As discipline deepens, confidence changes in texture. It becomes quieter. It is no longer tied to recent wins. It does not spike after good days or collapse after bad ones. It is anchored in repetition. You trust yourself because you have evidence that you will follow your standards. Not perfectly, but consistently. This trust reduces anxiety before sessions. You no longer wonder whether you will sabotage yourself. You have built enough history of alignment to feel stable. From this stability, scaling becomes rational. Size increases not because you feel excited, but because your data supports it. You test slightly larger exposure and observe your state. If regulation remains intact, you maintain. If tension rises sharply, you reduce. Scaling becomes a measured experiment, not a leap. The transformation from emotional trader to regulated professional is rarely dramatic. There is no single breakthrough moment. There are hundreds of small decisions executed correctly despite minor discomfort. Over time, those small decisions accumulate into identity. You begin to see yourself as someone who honors limits, someone who accepts loss without escalation, someone who can sit in uncertainty without urgent action. That identity extends beyond trading. Patience improves in other areas. Emotional reactivity decreases. Decision-making becomes more deliberate. Trading becomes a mirror, but also a training ground. The market does not reward hope. It does not punish fear. It simply reflects the quality of your decisions over time. When decisions are made from regulation, results tend to stabilize. Not perfectly, but directionally. At this stage, discipline no longer feels restrictive. It feels liberating. You are free from the constant negotiation with yourself. Free from chasing. Free from emotional swings tied to every tick. Freedom in trading is not the freedom to act impulsively. It is the freedom from impulsivity. It is the freedom to execute your plan and accept the result without internal chaos. And that freedom is built quietly, trade by trade, session by session, small size first, stability first, survival first. Profit follows those who can remain consistent long enough.